Welcome to Tech Money Madness Weekend Edition, your bite-sized investor education series. Today's topic, volume analysis, the truth behind every move.
Glad to be here for this one.
So I think we've all had that moment where we look at a stock screen and, the price is just plummeting.
Oh, yeah, pure panic.
Right, like completely divorced from reality. But if you actually know how to look under the hood at the trading volume, you'd see what's actually happening, like the engine of the market just seizing up.
Which is exactly why volume is, honestly, the ultimate lie detector for the market.
The lie detector, I like that. So our mission for this deep dive is to figure out why that is, why volume tells the truth when the price is, lying to us.
Well, think of a stock's price as just a claim, right? It's the
Yeah.
market shouting like, hey, this company's worth exactly this much right now.
Okay.
But the volume, the actual number of shares changing hands every day, that is the proof. If a stock jumps, say, 10%, but only a tiny fraction of its usual shares are traded.
I mean, that's a pretty hollow claim, right?
Exactly. It's totally hollow. To understand the real conviction, you have to look at the volume. That's the machinery driving the price.
And most of you listening probably know the basic definition, right? Volume is just the number of shares traded over a specific period.
Simple enough?
Yeah, and we all kind of understand liquidity. But I want to look at this from the perspective of a massive institutional player, like a giant pension fund.
Oh, that changes everything.
Right, because when the CFA Institute talks about high volume being crucial, they aren't worried about me or you buying 50 shares. They're terrified of institutional slippage.
Slippage is the nightmare for those guys. Because for a retail investor, the market is like an ocean. You can buy or sell instantly.
But for a multi-billion-dollar fund.
Yeah, for them, it's a kiddie pool. If they want to move 5 million shares, they can't just drop a market order. They'll displace all the water.
They just eat through every available buyer at that price.
Right, and the algorithm will just keep matching them with lower and lower bids.
Yeah.
They drive the price down against themselves.
So they're literally causing their own losses. Let me try an analogy here. Selling a highly liquid, high-volume stock, it's like selling fresh apples at a packed farmer's market.
Okay, I see where you're going.
Like you have the apples, there's a huge crowd, you get your asking price, instantly, boom, done.
Sure.
But selling a low-volume stock that's like trying to sell some super rare, obscure comic book.
Right, the buyers just aren't there.
Exactly. You might have to slash your price drastically just to find the one guy willing to buy it today. That price drop is the slippage.
That's a great way to put it. And for a hedge fund, that slippage is a measurable, catastrophic loss of capital.
So how do they avoid it? They can't just eat those losses, right?
No, they hide in the volume. That's why high average daily volume is their lifeblood. If a stock trades 50 million shares a day, they can quietly sell their 5 million shares over a week.
Without anyone noticing.
Without moving the needle at all. They use algorithms like iceberg orders. Only the tip of their massive order is visible.
Oh, wow. So they just drip feed it into the market.
Yeah, the algo sells a small block, then instantly replenishes it with another small block.
So to us, the retail traders, it just looks like normal background noise.
Totally normal. But under the surface, this massive whale is offloading a huge position.
Which brings us to the real meat of volume analysis, right? If these institutions are actively trying to hide their footprints, how do we actually use volume data to track them?
Well, we look for the shifts in supply and demand that they can't completely hide. We look for accumulation and distribution.
Let's break those down, starting with accumulation.
So accumulation is basically when the smart money is building a position. They're buying.
But carefully so they don't spike the price.
They try. But the footprint still shows up on the volume chart. You'll see periods where the trading volume steadily increases, especially on days the stock closes higher.
So the price might just be going sideways, like flat for weeks.
Exactly. It looks dead. But if you look at the volume bars, they're subtly swelling. The buyers are quietly absorbing every share the sellers offer.
It's like hydraulic pressure, right? The tank isn't expanding, the price is flat, but the pressure inside is just building and building as more fluid is pumped in.
And eventually,
the valve blows, and the price breaks out.
Yes. The volume tells you the pressure is building way before you see the breakout.
Okay, so that's accumulation. But the inverse of this distribution, I feel like this is where retail investors get absolutely crushed.
So they get completely trapped. It's brutal.
Walk us through the mechanics of distribution, because I think this is where volume really acts like that lie detector.
So distribution is when those same big players decide to take their profits, they want to sell. But remember the slippage problem.
Right, they need buyers. A lot of buyers.
Exactly. They need a massive influx of willing buyers to absorb those shares without tanking the price. And when do you usually get that?
Right after a massive run-up or like a huge news
The
announcement?
FOMO phase.
Yeah.
Fear of missing out.
The stock hits an all-time high, everyone on TV is talking about it, and retail traders are just rushing in.
And the institutions are more than happy to hand them the bag. During distribution, the price might keep rising, or at least stay high. But the volume,
It's dropping.
it's steadily decreasing. Or you'll see massive volume on red days and terrible anemic volume on green days.
I'm picturing a live concert.
Okay, hit me.
The price is the band playing on stage, right? And the volume is the crowd's energy.
Ooh, I like this.
So the band hits this incredible high note. The price goes to an all-time high. But if you look around, the crowd is actively walking out the doors.
The party is over.
Right. The volume is decreasing. The momentum is totally hollow.
That is exactly what distribution looks like. The heavy lifting that drove the rally is gone, and the only thing keeping it afloat are those late retail buyers.
Wow. So when you see a rising price on decreasing volume,
It's a massive red flag. The trend is running on fumes.
but manually reading these charts sounds incredibly tedious, like squinting at red and green bars trying to guess if they're slightly higher than last Tuesday.
It's totally subjective if you do it that way.
So how do the quants do it? How do they systematically spot this stuff?
They use cumulative metrics. Investopedia and a lot of the standard industry guides point to a tool called OBV on balance volume.
Unbalanced volume. Okay. How does that actually calculate the money flow?
It's brilliantly simple.
Yeah.
OBV is a running cumulative total of trading volume. It turns raw volume into a single continuous line on your chart.
Okay.
It calculates it daily based on the closing price. If the stock closes higher today than yesterday, it takes the entire day's volume and adds it to the running total.
Wait. Let me clarify this for the listener.
Sure.
If it closes lower, it subtracts the entire day's volume.
Exactly. Plus or minus, based entirely on the price direction.
I gotta challenge that. Mathematically, that sounds like a really blunt instrument.
It is blunt.
Think about it. Say a company reports earnings, massive volume, right? Like 20 million shares traded. It swings wildly all day, but at the bell, it closes up by exactly one single penny.
Just 1 penny.
Yeah. Does the OBV indicator seriously add all 20 million shares to the positive side just for a 1 penny gain?
It absolutely does, every single share.
That seems flawed. It doesn't care about the magnitude of the move. $10 or 1 penny, it treats it the exact same.
See, that bluntness is a feature, not a bug. If you try to weight the volume by the size of the price move, you basically just recreate a price chart.
Oh. You'd lose the independence of the volume data.
Exactly. The magic of OBV is the law of large numbers. Over weeks or months, those daily additions and subtractions build an incredibly accurate picture of the underlying pressure.
So we aren't caring about what OBV does on one random Tuesday.
Now, we're looking for divergence over time.
Divergence between the price and the OBV line.
Right. Think back to your concert analogy, the distribution phase. The stock might make a brand new high, but when you look at the OBV line, it's sloping downward.
It failed to make a new high.
Exactly. That divergence tells you the new price high was made on thinner volume. The smart money is leaving.
So the price is screaming, we're going to the moon. But the OBV line is whispering everybody is actually heading for the exits.
It exposes the lie. And in an accumulation phase, the price might be grinding lower, frustrating retail traders into selling. But if OBV is marching upward, big money is quietly scooping up those shares.
Okay, that actually makes the blunt math make total sense. It catches the aggregate trend.
It does.
But let me play devil's advocate here. We're calling this the ultimate lie detector, but we live in an era of high-frequency trading. Can this truth be manipulated?
Oh, absolutely. And that's the biggest trap sophisticated investors fall into.
Over-relying on volume.
Specifically, misinterpreting the relationship between a sudden price drop and a massive volume spike.
Because the instinct is to see a huge volume spike and think, oh, a new trend is starting.
Right. It looks like accumulation kicked into overdrive. But often, it's just an engineered mirage.
Engineered by who?
High-frequency algorithms. They're programmed to hunt for liquidity. They know exactly where retail traders put their stop-loss orders.
Stop-loss hunting. Let's break that down. Because it directly messes with the volume footprint.
Say a stock has strong support at $50. The algos know there's a huge cluster of automated sell orders, stop losses, sitting right at $49.90.
Because retail traders put them there to protect themselves.
Exactly. So the algos see that cluster as a giant guaranteed pool of liquidity. They aggressively short the stock to push it just under 50 bucks.
And the second it hits 49.90.
Boom. All those retail orders trigger at once. They become market sell orders. It causes an avalanche of selling, which prints a massive, scary red volume spike on the chart.
So if I'm watching my screen, I see support break on record volume. My training says massive distribution, panic sell.
And that's what the algos want. Because what do they do next? They pivot. They use your panic selling to buy huge blocks of shares at a discount.
Wow.
Within an hour, the price is back over $50, and retail is trapped outside.
So that volume spike wasn't a trend reversal. It was just a trap, a liquidity vacuum.
Which is why the source material stresses. A sudden, singular volume spike is usually a sign of exhaustion, not a new trend. Real accumulation takes time.
It's a steady swelling, not a one-day explosion.
Exactly. You can't look at it in isolation.
Which really sets up the warning from the CFA Institute guidelines we researched. I mean, we can watch OBV, we can dodge stop runs, but if we only look at the tape, we're flying blind.
Volume analysis is powerful, but it only tells you market mechanics. It tells you how much capital is moving and when.
But it doesn't tell you the why.
Right. It is fundamentally incapable of telling you why a trend is failing.
Like, it tells you people are running out of the building, but it doesn't tell you if there's actually a fire.
For that, you need fundamental analysis. Why is OBV diverging? Is a competitor launching a new product? Is there a flaw in the balance sheet?
Volume gives you the signal to look closer.
But fundamentals tell you if the signal makes sense in reality.
You have to marry the technical truth with the economic truth. So let's synthesize this for everyone listening, the core takeaways for this week.
Okay, first remember the liquidity game. Massive volume isn't just about popularity. It's the physical space required for institutional money to move without causing slippage.
Second, stop trusting the price claim without verifying the volume proof. Look for accumulation and distribution. A rising price on shrinking volume is a sinking ship.
Third, use OBV to cut through the daily noise. Don't sweat the one-penny anomalies. Look for macro divergence over time.
And fourth, beware the sudden spike. Remember that algorithms trigger those avalanches to hunt stop losses. Always, always cross-reference technical signals with the fundamental why.
It really changes how you look at a chart.
It does. The price is just the marketing department, but the volume is the accounting department telling you what's actually being spent.
That's a great summary.
But, before we wrap up, we always like to leave you with something to chew on that pushes these boundaries a bit further.
Yeah, I have a mechanical thought for you all to carry forward. We've spent this deep dive in the perfectly quantified world of the stock market, right? Where we measure volume by exact shares.
Right. It's all highly regulated data.
But the physics of volume and liquidity, they apply everywhere. Think about the housing market in your neighborhood. Or like the secondary market for fine art or vintage watches.
Oh, markets with massive price claims but totally opaque volume.
Exactly. There's no OBV line for a 3-bedroom suburban home.
Right. If a house on your street sells for 20% over asking, everyone cheers. The price went up.
But what if it sat on the market for 8 months and it was the only house sold in a 2-mile radius all year?
Right. Is that a true market value, or is it just an illiquid anomaly?
Exactly. How do you calculate your own slippage risk when you go to sell your house when the volume is completely hidden?
That forces you to look for alternative metrics of liquidity in every financial decision, not just stocks.
You have to find the hidden volume when the data isn't just handed to you.
That is a brilliant framework to end on. That's all for this weekend's deep dive. Come back tomorrow for more investor education and weekdays for daily market coverage. Like, subscribe, and we'll see you next time on Tech Money Madness.